Hello, I'm Janet Kim Singh, Portfolio Manager on the Private Wealth team at Capstone Asset Management, and I'm with my fellow Portfolio Manager, Maria Dawes. Hello, Maria.
Hello.
So back in 2020, we were doing a series on retirement planning, and we do plan on resuming that in the near future. But today we are taking a bit of a break from that in order to discuss something that I think is very relevant right now, and that is how do we deal with FOMO? But maybe first, Maria, for those that might not know, what is FOMO and why did we feel convicted to talk about this topic today?
So, this is an acronym that was coined a few years back that stands for fear of missing out. It is defined in the Urban Dictionary as a state of mental and or emotional strain caused by the fear of missing out. We're living in a world where smartphones enable us to stay connected wherever we may be, and through this quick and easy access to information has emerged the fear of missing out. And yes, this is why teenagers, and maybe ourselves, are constantly checking our phones.
Guilty, yes. And I have to say, this is a trend we have witnessed in the past few years. And especially now, we have folks out there perhaps not able to work at this particular time, some with stimulus checks in hand. We also have the emergence and rise of cryptocurrencies, EV stocks, marijuana stocks, the list goes on. A lot is trending at the moment, and it seems now more than ever, everyone is looking for the next big thing and looking to those influencers, if you will, who are pointing us to the next big thing. And while we're not here to speak to those topics directly, we would like to address the fallibility of human behaviors and how this can markedly impact our investment decisions. After all, we are human beings with emotions.
It's true, we are emotional beings, for better or for worse. Relating to this phenomenon to themes of the last year, we continue to see a staggering inflow into many areas that we would suggest are fast becoming, if not already have become, overcrowded, perhaps in the unqualified hope that they may climb even higher still. And while we are not against seeing momentum or trend lines as useful indicators, because they can be useful, the tricky part lies in the timing of the trade. The saying, the trend is your friend until the end, when it bends, comes to mind. The crux of the matter, it's important to not let hype or the fear of missing out provide impetus in our decision making.
And as a case study, just taking a look at Zoom, which I'm sure we're all familiar with in these times, the PE or price to earnings ratio, which is the stock's cost per unit of earnings, at one point was over 2,000 in this past year. Compare that to the current PE of the US stock market at around 45.01 as of February 19th. So this company was about 44 times more expensive than the average PE across the S&P 500 index. So to be sure, this could be justifiable in some investors' eyes, a case of maybe buy high and sell higher. But we have to check ourselves and be sure that we're not investing or trading with this FOMO mentality, which is obviously easier said than done. So how do we do that? Because I know that there are those that are still wanting to take some speculative risks and can perhaps afford to play the markets a bit. Maria, what are your thoughts?
So I say that while we always encourage investors to make decisions based on sound fundamentals, regardless of how you intend to trade or invest, it's crucial to have both an entry and an exit strategy and to know what time frame you're working with. Is this a set it and forget it trade, or is this something you're trying to capitalize on in the short term? It's possible to take advantage of the opportunities in the market, but it's equally important to know the risks involved and to stick to your plan. In fact, you really should write your plan down to ensure it's clearly thought out and maybe even for accountability purposes.
Very good. So I'm off to buy some Dogecoin now. Just kidding. In all honesty, our goal here is not intended to dismiss or disrespect momentum or trend following investors, but to stimulate thought. And we hope that we've done so. Remember, for every success story that we are hearing about, there is also someone who has lost their shirt. So really, this is a cautionary tale, so to speak.
And as we wrap up, it's also worth reminding that at Capstone, we value a corporation using numerous fundamental factors to determine an intrinsic value. We practice disciplined investing to ensure that our human emotions don't cause us any behavioral bias. And we believe in the uncompromised pursuit of value. And with that, until next time,
Bye.
bye.